What is the price to gross profit ratio? The price to gross profit (PGP) ratio is a valuation metric that compares a company's market capitalization or stock price to its gross profit. It offers a more nuanced view than the price to sales (PS) ratio because it considers the cost of goods sold (COGS), giving insight into a company's production efficiency and pricing power. Formula: price to gross profit ratio (PGP) equals market capitalization divided by gross profit, or price to gross profit ratio (PGP) equals stock price per share divided by gross profit per share. Market capitalization: the total market value of a company's outstanding shares of stock, stock price x shares outstanding. Gross profit: revenue minus the cost of goods sold, COGS, stock price per share, the current market price of a single share of the company's stock. Gross profit per share, the company's total gross profit divided by the number of outstanding shares. Steps for calculation: determine market capitalization, multiply the company's current stock price by the number of outstanding shares, obtain gross profit, find the company's gross profit for the relevant period, trailing 12 months or the most recent fiscal year, from the company's income statement, calculate the PGP ratio, divide the market capitalization by the gross profit, or, using per share data, find stock price per share, obtain the current market price of a single share of the company's stock, calculate gross profit per share, divide the company's total gross profit by the number of outstanding shares, calculate the PGP ratio, divide the stock price per share by the gross profit per share. Example: let's say we want to calculate the PGP ratio for manufacturing company. Stock price per share $25, number of outstanding shares 5 million, total revenue trailing 12 months $100 million, cost of goods sold COGS $40 million, gross profit revenue minus COGS equals $60 million. Method 1, using market cap, market capitalization $25, stock price times 5 million shares outstanding equals $125 million, gross profit $60 million, PGP ratio $125 million per $60 million equals 2.08. Method 2, using per share data, stock price per share $25, gross profit per share $60 million divided by 5 million shares outstanding equals $12. PGP ratio $25 divided by $12 equals 2.2, $12 equals 2.08. In this example, manufacturing company's PGP ratio is 2.08. Analysis and interpretation: a PGP ratio of 2.08 indicates that investors are willing to pay $2.08 for each dollar of manufacturing company's gross profit. Lower PGP ratio generally suggests that a company is undervalued or that investors have concerns about its production efficiency or pricing power. Higher PGP ratio typically indicates that a company is overvalued or that investors have high expectations for its ability to control production costs and maintain strong gross profit margins. Factors to consider when analyzing the PGP ratio. Industry: the PGP ratio is most useful when comparing companies within the same industry, as different industries have varying cost structures and gross profit margins. Compare manufacturing companies' PGP to other manufacturing companies. Gross profit margin: companies with higher gross profit margins, gross profit/revenue, can justify higher PGP ratios because they are more efficient at converting sales into profit. Growth rate: companies with high revenue growth rates, especially those achieving improved gross profit margins, may have higher PGP ratios. Competition: the competitive intensity of the industry impacts the PGP ratio. Companies with strong competitive advantages may have higher PGP ratios. Historical trends track a company's PGP ratio over time to identify any significant changes in its valuation relative to its gross profit. Business model. Different business models have varying gross profit characteristics. Compare retailers to manufacturers to technology companies, etc. Limitations of the PGP ratio. Ignores operating and other expenses. The PGP ratio only considers revenue and COGS. It does not reflect a company's operating expenses, interest expenses, taxes, or other expenses. Industry-specific PGP ratios are most relevant for comparisons within the same industry. Still needs further analysis. A low PGP ratio alone is not enough to declare a company a good investment. It requires more research and additional factors to consider. When to use the PGP ratio, comparing companies within the same industry. This ratio is best used to compare the valuations of companies within the same industry that have similar business models. Assessing production efficiency provides insight into how efficiently a company converts sales into gross profit. Valuing companies with varying profitability, a better valuation metric than price to sales when comparing companies with widely different gross profit margins. In summary, the price to gross profit ratio offers a more refined valuation tool than the PS ratio by considering a company's production efficiency and pricing power. However, like all valuation metrics, it should be used in conjunction with other financial ratios and qualitative factors for a comprehensive investment analysis. Follow vpcontroller.com for more content like this.